What if the biggest YouTuber on earth didn't just want your views? He wanted your bank account. 460 million subscribers. One fintech acquisition. And a question Wall Street doesn't want you asking. When the creator is the bank, who exactly is the product? In February 2026, a single Reddit post set the internet on fire. Quote, MrBeast just bought a bank. Within 72 hours, the post racked up over 40,000 upvotes and hundreds of panicked comments. But here's the number that should keep you up at night. The fintech app he acquired, Step, reportedly held over $2 billion in transaction volume. And the man controlling the front door to that money? A 27-year-old YouTuber who got famous giving away cash. This isn't celebrity gossip. This is the story of how the creator economy quietly built a parallel financial system, one where your attention is the deposit, your trust is the collateral, and your fandom is the exit liquidity. Today, we're going to unpack exactly how this machine works. First, we'll look at MrBeast's meteoric rise and why everyone trusted him. Then we'll expose the cracks nobody wanted to see. After that, the deeper financial architecture that turns fans into products. And finally, and this is the part that matters most, how this directly threatens your wallet, your data, and your savings. The most shocking part? It comes at the very end. Stay with me. Let's set the stage. The creator economy in 2026 was valued at an estimated $250 billion globally. Platforms like YouTube, TikTok, and Instagram had turned ordinary people into media empires. Brands were pouring money into influencer marketing, over $21 billion in 2025 alone. And at the very top of this pyramid sat Jimmy Donaldson, known as MrBeast. His channel crossed 460 million subscribers, making him the most followed individual creator in YouTube history. Meanwhile, fintech was booming. Apps like Cash App, Venmo, and Chime were pulling tens of millions of users away from traditional banks. The stage was set for someone to merge these two worlds. The only question was who? Meet Jay. Jay is 28, works a warehouse job in Ohio, commutes 35 minutes each way, spends about $60 a week on gas. Predictable. Comfortable. Every evening, Jay kicks back and watches MrBeast videos. It's his ritual. And honestly, why wouldn't it be? MrBeast was the internet's most generous man. He gave away millions, cars, houses, entire islands. He planted 20 million trees through Team Trees. He removed 30 million pounds of trash from the ocean with Team Seas. His Feastables chocolate bars were flying off shelves at Walmart, reportedly generating over $250 million in annual revenue by late 2025. Beast Burger had expanded to over 1,000 virtual kitchen locations. Everything MrBeast touched turned to gold. Forbes estimated his net worth at over $700 million. Investors were lining up. In early 2025, Beast Industries reportedly raised capital at a valuation near $1.5 billion. Think about that, a YouTube channel valued like a unicorn startup. Jay didn't just watch MrBeast. Jay trusted MrBeast. Jay bought Feastables bars for his kids. Jay downloaded the Beast Burger app. When MrBeast said something was good, Jay believed it. Millions of Jays believed it. And that trust, that was the most valuable asset on the entire balance sheet. But the truly terrifying part? That trust was about to become collateral for something Jay never signed up for. But here's where it gets wild. Behind the philanthropy and the viral stunts, cracks were forming. In mid-2024, former employees began speaking out. Reports surfaced of hostile workplace conditions, allegations of inappropriate content involving minors connected to associates, and lawsuits from contestants on his Amazon show Beast Games, who claimed unsafe conditions. Over 1,000 contestants, $5 million prize, and multiple hospitalization reports. The brand that seemed untouchable was suddenly under siege. Then came the Step acquisition. In February 2026, Beast Industries quietly acquired Step, a fintech platform originally designed as a banking app for teenagers. Step had launched in 2020, backed by investors like Stripe, and had reportedly signed up over 7 million users, many of them under 18. Now pause and think about that. A creator facing workplace scandals just acquired a financial platform whose core users are minors. But the business logic was ruthless. Traditional banks spend between $200 and $300 to acquire a single checking account customer. Fintech apps like Chime spend roughly $30 to $45 per user. MrBeast? He could post one video and drive millions of signups for effectively zero marginal cost. His customer acquisition cost approaches zero. That's not a bank, that's an attention to deposits conversion engine. Here's an everyday way to think about it. Imagine your favorite pizza place suddenly started offering mortgages. You trust their pepperoni, so maybe you trust their interest rates too, right? That's the emotional shortcut MrBeast is exploiting. Jay saw the announcement on his feed. His face froze. Wait, MrBeast wants my banking info now? Jay's thumb hovered over the download button. He trusted MrBeast with his entertainment. But his savings? And here's the part that should genuinely alarm you. I'll reveal the full financial architecture in just a moment. Because the real danger isn't MrBeast himself. It's the system he's plugging into. Now here's the twist nobody's talking about. MrBeast didn't buy a bank. He bought something far more powerful, a distribution layer for financial products. Step doesn't hold your money directly. The actual banking infrastructure runs through FDIC-insured partner banks like Evolve Bank and Trust. Step is the interface, the pretty screen, the brand, the push notifications. This is called banking as a service, and it's a $130 billion industry projected to hit $300 billion by 2028. The partner bank handles compliance. The fintech handles the user. And MrBeast? He handles the attention. Think of it like a shopping mall. The bank is the landlord who owns the building. Step is the store with the flashy window display. And MrBeast is the celebrity standing outside pulling crowds in off the street. The mall makes money whether you buy something smart or something stupid. Now, here's the concept you need to understand. Attention-driven deposits. In traditional banking, people choose a bank based on interest rates, branch locations, reputation. In this new model, people choose based on who they follow on YouTube. A 2024 Morning Consult survey found that 47% of Gen Z consumers said they would try a financial product recommended by a creator they trust. 47%. That means nearly half of young consumers are making financial decisions based on parasocial relationships, one-sided emotional bonds with people who don't know they exist. What if MrBeast had never entered finance and Step had simply continued as an independent fintech? It likely would have remained a modest teen banking app, maybe reaching 6 or 7 million users over 5 years. Instead, with MrBeast's distribution engine, projections suggest Step could hit 20 to 30 million users within 18 months. That's not organic growth. That's attention-fueled hypergrowth. And in finance, hypergrowth without proportional risk infrastructure is how things blow up. Remember Celsius network? It promised high yields, attracted millions through influencer marketing, and collapsed in 2022, wiping out over $4.7 billion in user funds. Different product, same playbook. Trust first, due diligence never. Jay downloaded the app. He figured, why not? Free debit card, cashback on Feastables purchases. He linked his checking account. He didn't read the terms of service. Nobody does. But buried in those terms is the real product, and it isn't the debit card. It's Jay. So here's why this matters to you. Yes, you, watching this right now. You might think, I'm not a MrBeast fan. I'd never bank with a YouTuber, but this model is spreading. Logan Paul promoted CoffeeZilla exposed crypto schemes. Kim Kardashian paid a $1.26 million SEC fine for promoting Ethereum Max without disclosing she was paid. FTX recruited Tom Brady and Steph Curry before vaporizing $8 billion in customer funds. The pattern is identical every time. Beloved figure builds trust. Trust gets monetized into a financial product. Fans become the exit liquidity when things go south. Exit liquidity means you're the last one holding the bag. You bought in because you trusted the face on the screen. The insiders already cashed out. Now, regulation is scrambling to catch up. The CFPB, Consumer Financial Protection Bureau, has been investigating fintech bank partnerships, and Evolve Bank itself received a consent order from the Federal Reserve in 2024 for deficiencies in risk management. The very bank powering Step's backend was flagged by regulators. Jay checked his Step balance one Tuesday morning. His direct deposit hadn't cleared. He called customer support. Automated message. He tweeted at MrBeast. No response. Jay sat at his kitchen table, face tight with worry, staring at a balance that read processing for the third straight day. This isn't hypothetical. Synapse Financial, a banking-as-a-service middleware company, collapsed in 2024, freezing over $100 million in consumer funds across multiple fintech apps. People couldn't access their own money for months. The FDIC insurance that supposedly protected them? It covered the partner bank's deposits, not necessarily the fintech layer sitting on top. If you use any fintech app, not just Step, ask yourself, do I know where my money actually lives? Because the answer might scare you. Throughout history, every new financial system follows the same arc: innovation, euphoria, exploitation, regulation, and then sometimes reform. Railroads in the 1800s, dot-com stocks in 1999, subprime mortgages in 2007, crypto in 2022, and now creator-driven finance in 2026. The technology changes. The human psychology never does. We trust faces more than institutions. We follow charisma more than compliance documents. And every single time, the people who pay the price are the ones who confused entertainment with financial advice. MrBeast didn't break any laws by acquiring Step. He might even build something genuinely useful. But the system he's tapping into, where a single viral video can move more deposits than a regional bank's entire marketing budget, that system has no guardrails yet. So I'll leave you with this question. In a world where your favorite creator can become your banker overnight, who's protecting your money? The algorithm, or you? Jay still uses the app. He just moved most of his savings back to his credit union. Smart move, Jay. If this opened your eyes, smash that like button and subscribe. Drop a comment. Would you trust a YouTuber with your bank account? Share this with someone who needs to hear it before they download the next influencer finance app. I'll see you in the next one.